the simple question. The template cannot be as simple as go out and buy the dip, because the underlying economic scenario for a country like India as well has changed considerably, with crude being where it is. Even if it doesn't stay at 130, but if crude at 100, 110, it's still nasty compared to crude at maybe 70, right?
So I'll come back to India at the end, but what it means for Europe in particular is that, at best, Europe will have stagflation, but it's looking more and more likely that it's going to fall into recession. With oil prices where they are, I think stagflation is something that you could really talk about now in the US. Now, markets doesn't like any of those two scenarios, stagflation or recession. So that's what they've got to grapple with. How long will the conflict continue, and how much damage will it have, to the global economy? Now, for India, obviously, fiscal deficit, interest rates will have to rise in India. That's for sure. Otherwise, the currency will head towards 80 very quickly. And that in itself brings in inflation, right? Because you're depreciating currency and so forth. So why have foreigners continued to sell? Because anyway, from October onwards, they were expecting interest rate hikes in the US. And when that happened, we spoke about this before, they tend to sell emerging market assets, whether it's currencies or markets and so forth. Now, with this high inflation and growth concerns, then obviously, everyone's just taking risk off the table. Safe haven is obviously dollar and the Swiss franc at the moment, and that's about it, because everywhere else in the world is going to be hurt by higher oil prices. Even though prices in the US are rising, they do have a large supply, so they can look after themselves to some extent.
Andrew, is this your fear of yours of stagflation at best and a recession in the most likely event? Let's put it that way. Or recession also likely. Let me not put words in your mouth. But that narrative or that belief, is it now a near certainty, even if the conflict were to end in the next few days? Has the damage already been done?
So let me take the two sides. Let's say it continues a little bit longer than we expected. Then what will happen at some point? The increase in commodity prices and food prices will have a demand destruction element to it as well. Because obviously, if you're sat in, say, the UK, and you've got £100 as your disposable income, half of that might be going down to new energy bills or food prices. So you'll have less disposable income, therefore demand generally for products and services will start to fall. So it will bring commodity prices down at some point, and that's probably why recession is first and then commodity prices fall. So I'm a little less worried about that in the kind of longer term. But I think if things were to normalize, when I say normalize, there's some kind of ceasefire, then there's two things that will happen. One, commodity prices will fall, obviously. And then if it's a ceasefire where trade starts to happen, sanctions move away, then obviously we will start to see that supply chain start to improve again, and therefore again prices will fall. But the fact is that you've still got to tackle inflation. It's not going away. So you'll go to the next phase, which is the interest rate environment globally. And the Fed have already said 25 basis points. I suspect if you had a ceasefire tomorrow, they'd do 50, just to get things under control and get things moving. So, but I think the market will rejoice that in some respects. And on a more optimistic view, if your scenario came true, then there's a few things that I think, two or three big trends which will happen. Governments will do what? They'll look at their foreign reserves and say, we don't want to fall into this trap, in any future date. So should we be having dollar-based assets like the US dollar? So will it mean to a lower depreciating dollar over time? I'm not saying everyone's going to sell their US dollars tomorrow. Second, governments and companies are going to say, what is our supply what's the problems with any supply going forward? So if you think about it, you'd naturally say, should I be buying semiconductors from Taiwan at the moment, given there's a risk of China's intentions there? So you're going to start to look and say, we need to have more of this in our own country, right? You've seen it with Germany, defense spending starting. Renewables is going to be the next big area because of the oil price and gas prices. Therefore, everyone's going to look at where do we have a gap in our supplies, so that we can start filling at home. So the capital expenditure from each of the countries towards these areas could be very, very significant. And that will lead GDP growth going forward.
That will also be very inflationary over medium term, Andrew, since the lowest cost producer goes out of the equation partly, if not wholly.
Yeah, so you're saying it could be, but it's not going to happen. No one's going to start spending straight away. So commodity prices first would fall under your scenario of ceasefire, get back to normal supplies, no sanctions. And then you'll start to see companies and particularly governments saying, like we are doing, semiconductors in India, we don't have. We need to invest more. We need to give incentives to do more in these areas. So that will lead to I believe, a company capex cycle to fill in those gaps going forward.